All right, good morning, everyone. We still have those who are logging on, so we'll give them a couple minutes. And I'll start with a big thank you. Thank you for attending today's presentation. We're going to take as deep a dive as we dare into the 2024 outlook in just a minute. And I do want to give a shout out. This is our 24th year working with Northrop Grumman Federal Credit Union. Hard to believe. And for those clients who are on from across the country, for those who are just getting to know us, again, good morning from Annapolis, Maryland, and thank you for attending. I want to be sensitive to your time. So without further ado, I'm going to go ahead and get started with today's presentation. So what you'll see here, as far as this title page, we have been very fortunate to secure this slide deck and with our partner Lincoln. What I like about this, these are such timely topics, and we're also able to glean information from a lot of our other financial institution partners. So it's not any one house in particular. And being an independent advisor associated with LPL Financial, that is one of the beauties of independence. So you can see here, we will be looking at slides from a lot of these different investment companies, many of which are probably very familiar to you. All right, we get to know what's on your mind when we have our various exchanges, whether it's someone new who is coming into the office to begin working with us here at Blue Heron, or for many, it may be during our ongoing reviews, looking at your individual financial situation in conjunction with the investment solutions that we use, and we get to hear what's on your mind. So as far as top subjects for right now, I think that we can all agree that these three are probably right at the top. One being, well, how is the US economy doing? Number two, we've been hearing a lot about interest rates, whether it's from Blue Heron Financial Group, whether it's from turning on the nightly news, whether it's interest rates that you're hearing about from friends or colleagues or family, interest rates on things like car loans and the housing market. Interest rates matter. And then last but not least, we have an election year this year for the president. So let's start with the economy and looking at this barometer, if you will, yellow being cautious, moderate thought processes. What we don't see is red on the screen here, indicating that there's likely some immediate need for caution. However, caution does exist with these various subjects. The green is where we have continued to be strong. So we Americans, and we'll see this in another slide, we are a consuming nation and spending has continued to be strong. Inflation, kudos to the Fed, Jerome Powell and company. Thus far, things have slowed down from those high inflation numbers we saw in June of 2022. Granted, we're not seeing it at the grocery store, and maybe we're not, but at least things are not continuing to skyrocket. So those are some good overall positives. And then whether it's growth in the economy, there is the likelihood that we are going to see that slowing this year. Labor market has been extremely strong through the last several years. However, it does seem that we're hearing about more layoffs starting to happen. I think it was just yesterday, UPS laid off 12,000. So those are seeming to come in, but it's nothing that's causing immediate big concerns. And then as far as consumer finances, going back even to COVID and stimulus, and we're going to take a look at fiscal responsibility and policy in just a bit. But as we all know, there was a lot of fiscal stimulus happening, and that put money in the consumer's pocket, which in turn drove up the spending and in turn the inflation. But that has subsided. A lot of that savings has been spent. And now for some on the bottom tier, economically speaking, there is an increase in credit cards usage and delinquencies. And unfortunately, with that comes just sky high interest rates and a never ending how do you get out from under situation. So I would just call this cautious. The outlook here is cautious. All right, we talked just briefly as far as a subject we were going to spend a fair amount of time on, and that's with regards to the Fed. Now, granted, we're keyed into this, it seems like not just on a daily basis, but almost on an hourly basis. And later today, we'll hear from Fed Chairman Powell as far as the language. That's what we're paying attention to. And we had such an aggressive Fed tightening happening once the Fed got over the thought process that it was transitory. You might remember that word that was being used. Well, you don't hear that anymore. Haven't heard that for a while, because clearly it was not transitory inflation. And so quickly the Fed started raising interest rates through 2022 and through 2023. And in turn, and we'll see this in just a bit, what the impact was on the fixed income market. But I also want you to take a look at this slide here as far as what happens after the Fed stops raising rates and actually starts cutting rates. And you'll see if there's not a recession, if a recession has been avoided, then there can be some very strong returns. That's what has happened historically going back to 65. If there is an average recessionary period, then you're looking at nominal returns in that mid-single digit. And then if there is a recessionary period, then there could be that negative happening 12 months out. We're going to look at a few slides on the presidential election. And as far as our conversations with clients, they could be tilted one way or the other from their preference as far as the upcoming election. And it's really important for those of us in the investment advisor community to maintain, as far as investing is concerned, a very bipartisan position. What you're looking at here is going all the way back to 1932 and what the market did. Now you're going to first take away that this is an upward trajectory, and I want you to please keep that in mind. However, there is oftentimes volatility in those months leading up to the election, the uncertainty, and the stage that is in front of us, it's filled with drama. I think we can all agree. But also, please take a look here at these various periods of time, whether Democrat or Republican, the average 10-year return is in that 10.5 to 11.2 range. So regardless, again, average 10-year returns are really neck and neck through that period. So just spending a little bit more time here and hopefully reinforcing that the markets don't really care who's president. Now, we'll leave it to our chosen investments and the managers of those, whether mutual funds, ETFs, whether they may want to be slanted in their portfolios based on what government spending, for example, might be. We're hearing a lot more about defense spending, perhaps that scenario, for example, that we might see portfolio managers leaning towards. Again, that's just an example. Election results have had very little impact on long-term investors. Markets have performed well under both parties. Stocks trend higher over time, regardless of administration. And we've been here many, many times before. We can think back to election night. My husband's usually glued to the screen. By that time, I'm in bed by hours because nothing's going to change once those election results are in, right? So again, it really comes back to how is the economy prevailing, but expect to see volatility as it leads up to the elections. I found this to be pretty interesting. Approval ratings, we hear about those, high, low, in between. And the takeaway with this chart is it really is that in between on the approval ratings. You'll see through this gray bar on the screen here that the average return when there's kind of mediocre, average, I'll say average, approval ratings, that the market does pretty decently. It's the extremes on either side, really low approval ratings or high approval ratings, then we're seeing the negatives or muted returns on the upside. Rather interesting. I mentioned this before from our position. It is, let's look at our overall asset allocations and make sure those are intact and that we're still participating in the markets regardless. What you're looking at on this screen here is what that growth of 10,000 over, oh my gosh, decades and decades, 100+ years. Down at the bottom of the screen, if an investor chose to only stay invested, whether one political or the other political party is in office, then returns just are flat, basically flat, versus staying invested. So you hear us saying stay the course, there's a reason behind it. I think we can all agree that we've got some serious issues with regards to fiscal responsibility and the national debt. And we really cannot lay blame on either party. This has been kind of a mess in the making for many, many years. I can think back to when Clinton was in office, and again, not saying I liked or disliked Clinton, but I will say that it was, I believe, I'll have to check my memory on this, but it's sure the only time I can recall that there was actually a surplus. And the numbers are just not even fathomable as far as what this debt situation is now. So let's hope that there can be some agreement as we make our way through this election, looking into the future and coming together to tackle what is a continuing problem. Okay, I'll get off my little soapbox on that. The economy. I love these comparisons just over a really short period of time. There's been a lot of different movements happening. So interest rates, December 22 versus 2023, we call these basis points. This is a 100 basis point move. That's a big move with regards to interest rates. Again, where we see that affecting markets through 2022, it was a real negative for bonds. We're going to look at that closer in just a bit. Inflation at the end of 2022 at 6.4. So it was starting to come down from those high levels in June of 2022 when it was hitting 9%. Now, those of you on Social Security or receiving cost of living with your pensions, that's more on the governmental side, not corporate, not Northrop Grumman, but you saw a big jump on the Social Security through 2022 and 2023. and that's in the 3% range for 2024. So that's where that shows up. But you have seen that cut in half in basically a year's time. I mentioned earlier that we have a very strong labor market. It's remaining below 4%, and thank goodness, because that has helped with resilience in the marketplace. And that is also one of the Fed's mandates to keep an eye on that unemployment rate in the labor market. So from a big picture, here's where we are. And that's been with these high interest rates. Inflation has been coming down, a moderating labor market, so still strong, maybe coming, those numbers are changing a bit, a resilient economy, and consumers, corporations, they're still spending money. I mentioned this before with regards to some defense spending that we're seeing and what money managers are doing. So there is certainly escalated geopolitical uncertainty. So trends going forward, you've seen this with some of the Mag 7 stocks. The big buzz has been about AI. And there's also, again, it's been interesting to see this demographic shift, which, you know, many of you on the call are these aging baby boomers. Deglobalization has been ongoing, increasing. What happens around the world, we're all intertwined in a big way. And what's taking place in the energy markets too, that's been an ongoing topic. Okay, GDP has been actually rather robust, but the expectation is that we'll see that come down to some extent. But the big takeaway here is we are still expecting to see our economy growing. Now, these numbers were real strong. Your balances in 2021 in your investment accounts were reflecting that very strong economy. Then we saw, I'm sorry, that was the bounce back after COVID. My apologies there. And then we had, during 2020, we had that recession period. So this, again, is the American consumer still alive and well, although we are seeing some reductions on the spending side of things. Other components of GDP, you'll see here housing, investment. This could be on the manufacturing side, for example, government spending and exports. But big takeaway, still looking for economic growth. I mentioned debt before. I guess I'm not finished talking about this. I saw a graph that was, well, maybe I'll have to send that out separately, but it was depicting just exactly from a picture standpoint what our national debt, how do you even quantify the trillions that is our American debt right now? And you can see that if changes don't come about, this is a problem. This is a problem. And, you know, on the one hand, fine, carrying debt is, on one hand, it's okay, but we cannot continue to support, you know, think about Social Security, Medicare, and they've got some work cut out for them. So we've got some pressure coming from that side. Leading indicators. Okay. And I apologize if I'm flipping through here rather quickly, but we have a lot more to get through. As far as the leading indicators, big takeaway here. Again, let's look at it from just even a color chart. We've got negatives on whether it's hours worked, new orders. The ISM is that's the big indicator that we pay attention to, and those numbers have been hanging out around 50. Consumer expectations, we did actually see a little bump with the Michigan confidence recently. However, expectations looking ahead on the negative side, yields are, and the spread is coming down. We'll look at that in just a bit. And I'm not going to go through each and every one of these, but really the strong points, once again, are on the employment side, spending, and stock prices. You'll have perhaps caught that we were hitting some all-time highs within the past week. We'll look at those valuations in a minute. ClearBridge puts out, ClearBridge Franklin Templeton now, there was a merger between Legg Mason, ClearBridge, and Franklin Templeton just last year, as a matter of fact. Franklin Templeton also acquired Putnam. So a lot of movement kind of behind the scenes here. But once again, just from a picture standpoint, what jumps out at you here are, and these are prior recessionary periods, but here's just a couple months ago, a lot of recessionary concerns out there. And I'll call this the longest talked about recession. While it may have kind of affected in different pockets of the economy, think the housing market side of things, but we haven't had that declaration that we have been in a full-blown recession. Once again, the markets remain resilient. So the areas that are standing out, truck shipments, you know, this is that Amazon truck, perhaps. It's showing up on a regular basis. Retail sales, have I mentioned consumer spending enough? Still strong, although perhaps is reining in a bit. And then have I mentioned this enough? Our labor market has remained strong, but there's still a lot of red on the screen here. Okay, so let's talk stocks. We had a great year in 2023, despite so many who were forecasting for 2023 to be a recessionary period. Didn't happen. We had strong S&P 500 returns, and you probably caught that it was the Mag 7, right? Gotta love the Mag 7. Gotta love all these little adages by Wall Street. Apple, Microsoft, Amazon, NVIDIA, Google, what am I missing? Meta, and that weighting within the S&P 500 that led to the overall S&P 500, boy, that was high. Roughly a third of the S&P 500 in the top 10 stocks. I think many on the call today will remember this period in 2000 when it was all about the tech stocks and they were hitting all-time highs. And we have to be very careful in those periods, not to say that we don't want to participate, because we do and we are, for those of us, or for those who are working with us. However, it's one of those, trees don't go to the sky. A pause in that type of movement wouldn't be a bad thing. And then we have valuations that we're looking at. This has gotten to be a bit of a pricey market right now. So once again, some caution at this point, I think, is due. I love this slide just because it's a great reminder that in any calendar year, we have negatives happening. That's all these blue dots across the bottom. But in 70+% of calendar years, what you're seeing with the red bars are positives with regards to the S&P. The only back-to-back-to-back period that you're looking at negatives, this was tough. This was a tough one. Goes back to that .com era, .com boom bust, and then that was followed by 9/11. So that was a really difficult period. This was the 08-09 we kind of call that one name, 08, 09, but at the end of 08, markets were down, had hit a low. I mean, imagine markets coming down 49%. That's ugly. They ended the year at negative 38. But the following year, even though there was still downward pressure, we ended the year positive. So takeaway here is the majority of calendar years, we do get positives. You hear us talk about growth and value often. We want to make sure in portfolios that we have both sides of the equation covered. This is giving us examples of the value sectors versus the growth sectors. So growth are those big techie names, for example. Value tend to be more dividend payers. Let's go back to 2000 again. It's all about, down here, 2000, all about growth, and yet things can turn on a dime. So what happened through that period shortly thereafter, we saw value stocks, and this is just such a good visual. We've also been rewarded through most of the second decade, I guess, on the technology side, once again, growth, and then we saw the value. We want to be on both sides, but we will think and be investing a bit more tilted towards the growth. Moving on, international, we've gone through a period where US stocks have been dominant. I believe I have that slide coming up in just a minute. International stocks are kind of on sale, if you want to think about it that way. I mentioned PE. The PE on the US market is lofty, frothy, all these different adages that we can, or names to it, versus international. So you can see this, maybe it's a little small, but I'll just tell you, we're pushing up on 20 on the PE with the S&P 500 versus below 13. This tells us that international stocks are better value, a better entry point than US at this point. And yields have been decent on the international side as well. This is what I was referring to as far as, again, things cycle. You saw before on that chart, the growth value that was on the domestic side. This is looking at the international versus US performance. We've gone through a long period with US performance. I'm not suggesting that all of a sudden this is going to change and international markets are going to outperform, but it is why we want to continue to participate on the international side to some extent. So some of these slides, I hope, as we're looking into 2024, are just really good reminders about how important it is to not react emotionally through difficult periods. If we do indeed have volatility picking up, whether it's because of geopolitical issues, whether it's because of the election coming up, I hope that this kind of come back to basics and why we have to continue to remain invested is so important, because human nature is that desire to avoid risk and to even potentially jump out at the worst times. The chart you're looking at here is looking at various recessionary periods. And then just here is a quick capture of what the market's averages were in the 1 year, 3 year, and 5 years later, cumulative returns through there. Again, strong returns after we make it through some pain. I guess that's where no pain, no gain comes from. Maybe that's on the exercise side. But back to the task at hand. I've been showing this slide a lot because we have finally, with those interest rates going up, have seen deposits in banks and credit unions. We've seen money market CD yields coming up nicely. and you can get some return. Just a minute, we're going to look at what happens after these are peaking. But these periods going back to 2000, so after the last 23 plus years, here was a peak in money market balances. This was a recessionary period. Here's January 09. Remember, we looked at that. That was, the 08, 09, bottom of, or December of 08 markets had taken a huge hit that continued to March of 09. And then we started to see markets going back up again. But that was a long, felt like forever period, but it was, and it did take a while. Money market balances increased through there. In 2020, this was COVID period. So you'll see that there is a direct correlation between, oh my gosh, the markets are coming unglued, that flight for safety. And not to say we stand by having assets in bank credit union, that those liquid reserves, call it what you will, rainy day fund, absolutely. But we don't want to get too carried away with it, because when interest rates start going the other direction, that's when we're going to see some of the other asset classes that are going to respond favorably, which is what this is depicting. So this is 3 years after these market highs. So look at this 03 to 06, money market rates and the returns on these cash-like vehicles dropping, and yet equity markets, strong returns. I'm not suggesting we're looking at this kind of return. However, history often is providing us some very good clues of what to expect. Same thing happened here in 09. You saw the markets resiliency, and then this is after the COVID. That was a very quick, very fast decline. Markets actually responded probably within just believe a few months and started making money again. So bottom line here is, yes, absolutely grab these yields for those liquid reserves, but we don't want to get too carried away with it and abandon our investment strategies. What I like about this slide deck, you may feel like I'm repeating myself, and to some extent I am, but showing you different graphs. This is that 73% of the time stock market has provided positive returns. Not going to spend much more time here. Fixed income has been a fun place to actually have conversation as we look into 2024. We've gone through this period, as mentioned, where the interest rate cycle was so aggressive. I did, I drew from the old 1994 book and look back, and that was nothing in comparison to the 2022, 2023 escalation of interest rates. And there is this correlation between the interest rates and what is taking place from an economic standpoint. At the end of 2023, on this bottom right corner, fixed income in 2023, we had expectations earlier in the year that we would have some decent positives. And it wasn't until the Fed indicated that they were finished, I believe that was November, and that's when we saw the fixed income markets responding so favorably, with core bonds ending the year in that 5.5% range, and in some cases moving up towards 6 and even 7. Yield curve is a great indicator as far as historically telling us that we have some recession concerns. This has been the yield curve that we've been looking at for 2023. On the short end, we've had higher yields then as we move along. This is starting to flatten to some extent, but it is still inverted, which again has been some indication in the past of recession. I'm going to have to move through here relatively quickly. This is a deeper dive as far as bonds and what happened in 2022. We had the worst bond market on record. So the blue here is showing us the price, the appreciation, and bonds got hit hard. Think about the existing bonds that may have had yields in the 2 to 3% range, and then new bonds are coming out at higher yields. That's a lot of downward pressure on existing bonds. That's a quick summation of what was happening. And then fast forward to, okay, we're done. Bonds are maturing. They're now grabbing these new yields in that 5 to 7% range. And then we're seeing that positive occurring. And that's where this roughly 5.5% across the bond world for 2023 happened. And our expectation is for bonds to do decently in 2024. I have to keep reminding myself it's 2024 and we're already a month in. So when the Fed pauses, which they have, and it's highly unlikely that we're going to see any change in that. What's interesting about this slide from BlackRock is this period of pause. So there was some noise, there's been some noise really since the start of the year that the Fed may cut rates 5 or 6 times this year. There's many weighing in on when that first rate cut will happen. There's also those weighing in on how that cut may be decided upon because of how close we may be to the election, and on goes the conversation. But I do want to focus on how stock and bond returns are responding in that pause period. And big takeaway here is they respond favorably across the board. So 6 months before the hike, the pause period, I'm not going to sit here and speculate on when the Fed may start cutting rates. I think that they have the ability to sit here and pause for a bit because the economy is still moving along, and they probably also just want to reserve some of that ammunition as needed to spur the economy along as they're waiting to see how their indicators are flowing. And then after the first rate cut, you can see equities, bonds continuing to perform. All right, I think we've kind of tackled that. CDs, this is important because we have indeed seen CDs in this 4 to 5, even higher than 5% range. They're starting to come down to some extent, but let's please keep in mind, if the CDs are used in your taxable accounts, that tax on that yield is indeed happening. The inflation is indeed also eroding those assets. So yes, jump on, grab some yield, absolutely. But this is where, again, we can't just go overboard in this direction, because this real return after you take away the tax implications and inflation showing us negatives, right? So that erosion on both taxes and inflation is indeed happening. So this is referred to as a Callan chart. We've shown this many times. What our job here is not to look at a crystal ball. We don't have one of those on anybody's desks here at Blue Heron or in the conference room. We want to make sure that we've got the bases covered, because as soon as we start thinking, anyone, any investor, as soon as you think that you've got it down as far as what that next asset class that's popping to the top is, my guess is that the markets are going to be humbling us. We want to stay in this more balanced area and not have the wild gyrations that can come about. So as we move along here, just some reminders as we consider investments in 2024. And for many on the call in the Zoom today, we have gone through our analysis, and you know that we take this out to age 100 because we sure don't want to plan on a shorter life expectancy and run out of money. Well, we know that these are averages, so averages for whether men or women is taking, you know, and again, depending if there's a couple, there's the likelihood of one reaching age 90. We all know those who are hitting those numbers. Allison in the office, her dad hit 99. So, you know, years ago, you didn't hear about that too often. We've got a plan for long term, and therefore we have to participate with the equity markets to offset those taxes and inflation. Market resiliency. 2023 really surprised some of those. Jamie Dimon comes to mind. Okay, he is the JP Morgan guy, and he was calling for a recession in 2023. You know, that's just one of many names who were calling for recessions for last year. And the S&P 500, double-digit strong returns, and then the bond market actually came out with a nice pop there at the end. November, December, extremely strong. There's some seasonality with November, December, and it showed up big time. This chart is looking at some periods of negativity. Any one of these we can remember. We go back to savings and loan crisis and the freezing up of, you know, getting money out of the banks. I've talked about the tech bubble burst. We had the financial crisis, and on it goes. But you take a step back, aside from these recessionary periods throughout, you've still got that upward trajectory. We talk a lot about distributions and retirement income in our conversations with clients. And for those who are just kind of nearing this period of, hey, I'm going to hang up my cleats. I've been saving for a long time. What is this going to look like? And there is a certain amount of anxiety in that period. We want to acknowledge that, but also to remind you that we're now 3 decades in here at Blue Heron Financial Group of successfully helping our clients to pave the way for their income needs throughout retirement. You hear us talk about withdrawal rates. We may be leaning a bit bolder if we're going through a strong bull market, but this big takeaway here is our safer zone and more realistic zone. Sure, if you're only taking 1 or 2% distributions from your portfolios, then you've got a very strong likelihood that, you know, you're going to have assets till the day that you depart this earth. So we've got to be careful with this. And we look at lots of different strategies, whether it's on the Social Security side, when to deploy from that, or from the taxes side, Roth. A lot goes into this, but we just want to remember that those withdrawal rates, it's really important that we keep an eye on those. Since no one has any idea when they retire, whether we are going to be in a strong next year, or maybe there's going to be some unaccounted for, as is usually the case in big market downturns. I'm talking about big market downturns. Black swan events happen. COVID was one of those, and things that come out of left field. So this sequence of returns is really important. It's why we sometimes talk about adding some protective strategies so we don't have to take as big a hit in down markets, or we can build in some income strategies to offset this risk. And what you're seeing here is an investment start of 500,000, and whether it was negative period to start with versus positive period really has set the tone for these 4% withdrawals happening either side. But this investor one is running out of funds. This investor two ends up still with a significant nest egg to pass on. So it is not a science by any means. It is an art and a science with regards to income strategies and distribution planning. This also is another look at what we just talked about, sequence of returns. It's one thing when we go through market periods and we're adding to our 401k plans, adding to our IRAs, adding to our investment accounts outside of retirement plans, and dollar cost averaging throughout. We can help smooth that ride. But if we're taking withdrawals, and this is referring to a 5% withdrawal, which I think is a little more aggressive than is comfortable, but just how much return is needed after negative periods. So here's a 10% loss. If there's no withdrawals happening, fine, we need 11 to get back to square one. If it's a 20% negative, we need 25 to get back. If we've got returns that are negative and we're taking distributions, these are some big, high returns that we would need to experience to get back. Again, it's not an art, it's not a science, it's an art and a science. Big reminder, again, we look at 2024, things can happen. But if we're not staying involved and we miss those best days, and humans being as humans are and wanting to get out a lot of times at the worst period, and the fact that 6 of the best 10 days happened within 10 of the worst days, how would you even know? So yes, we stay invested. Yes, we may moderate portfolios, we may change our weightings to some extent, but we must stay invested in order to experience the positives. Hopefully I'm driving this point home that we really, the last thing anybody needs to be doing is jumping out of the roller coaster at the worst time. And looking at different investors, this is the one that gets it right every time. This was at the start of 2009, after a negative period. Yay, him or her. But if we stay the course, then again, we've got some decent returns. This is showing us if there was a move to cash for a spell of 1 year and then decide to get back in. And then here's the investor that moved to cash and stayed there. Looking back at history, we see here on this slide negatives and then the total returns, the cumulative returns after these tough periods. And some of these were scarier than others. Some are forever, just etched into our memories. But from an investing standpoint, I can assure you these were not fun times, but you can see the returns thereafter. Long-term care, this is a topic that is coming up with our friends, our family, those of us in the sandwich generation with elder parents and still raising kids, this is a tough call. You can see that it is typically 51% of the time that the care for an elder is falling on an adult child. And then there's some other, family, friends, or relatives that are helping out here. The period of time where care is needed, once again, these are averages, whether you look at, women needing 5+ years here at 41%, there is a cost associated. It's a conversation we have with our planning, and that is to come up with a plan. We hear sometimes, well, my kids will take care of me. And our response is, well, you've had that conversation with them, right? And let's be serious here. If they're working and raising families, that may not be doable. So the answer to this has evolved over time, but please, if you have questions on how you might formulate a plan, let us know. These are big numbers here, and we could spend a whole hour talking about long-term care planning. We do that later in the year, and we'll make sure that you get those invitations. But again, these are big expenditures, and we have to consider how this care is going to be monetarily provided for. Tax rates. Remember that chart we looked at with the growing debt? Believe it or not, we are in a lower tax environment and have been for some time. This will sunset. Our tax rates as they stand today are going to sunset at the end of 2025. If nothing is done, those tax rates are likely going to be jumping, and in some cases, pretty significantly. So you can see here on the chart, if nothing at all is done to address this, the numbers are big. The tax implications are big. Something has to happen to turn that unbelievable deficit so it's not going to be to the detriment of our country. How that's going to happen, I don't know, but the go-to in many cases is going to be from tax revenues. So nobody is going to not have to feel that. And taxes cause a drain on our investments. It's why with our non-retirement assets, or even looking ahead at such a thing as Roths and Roths conversions, why we're having those conversations. And if we're not cognizant of it, then we've got this drag of taxes happening on our returns. All right. We talked about a lot of different things today. Please give us some feedback. We'll put up a slide here on the end. Feel free to relay your thoughts, questions to Debbie, who can get them out to me or to Sarah. And if we can't answer, then we've got resources to go to. And disclosures here. We thank Lincoln. We like their slide deck. I'll be curious if that you felt that this information is relevant. Please let us know. We want to hear your comments, and if there's other topics that you want us to address. So we saw those big takeaways at the very beginning with regards to it's an election year. What are interest rates going to do? How is the economy going to respond? These are things that we're going to continue to keep an eye on. And in any of our strategies, we've got to be thinking in terms of if the market responds favorably, we want to be on board. If we have negative markets, we want to make sure we've got some protection in place. That has been ongoing throughout all of our years, and it will continue to be. So thank you again for attending. You've got Debbie's information here in our office. Please feel free to send us any kind of communication questions. And we thank you for your time. And I get to give you 5 minutes back. There you go. Have a great rest of your week, and we look forward to talking to you in 2024.